Welcome back to GBA2, Directing Benefit Programs, Part 2, Module 3, Controlling Risk Factors. In this second segment, we're looking at some of the impact of ACA provisions on health services and insurance marketplaces. I remind people of the 3 R's to help stabilize the individual and small group marketplace. The whole concept of the 3 programs were temporary, the reinsurance and risk programs, while the third program is permanent, the risk-adjusted program. So let's look at those 3 concepts. Now, you might say, why are we studying a concept in 2 of the cases that were only around for 3 years? The reason is a lot of the background to the concept is being resurrected in other aspects of the health insurance arena. Basically, the risk-adjusted related provisions of the Affordable Health Care Act had the permanent risk-adjusted model, the individual and small groups, and it was used inside and outside the exchanges and definitely attracted more high-risk or fewer low-risk patients than other models that are out there. So that's the concept, and it's a permanent one. The 2 temporary ones, better known as transitional, were only meant for 3 years, but aspects of it are still coming to light. The risk corridor method for individual and small groups, and the reinsurance method for individuals inside and out of the insurance exchanges. All have aspects that we're going to now expand on. First of all, the ACA initiated programs that were really meant to address concerns over the possible substantial differences in claims experiences across insurers, which was causing some premium volatility. So recognizing that concern, the ACA risk-adjusted program was born. And it is a permanent program, the ACA risk-adjusted program. Its focus is having a goal to redistribute funds from lower risk enrollees to plans with higher risk enrollees to encourage insurers to focus on value, not volume, and efficiency, and not to merely cherry pick the good risks. Now, 2 other programs were created, which since expired in 2016, and to clarify, that was the ACS Temporary Reinsurance Program and the ACS Temporary Risk Corridor Program. But we really need to look at all 3. Let me expand on them. First of all, clarifying adverse selection. It occurs when consumers who are most in need of health are most likely to purchase insurance, and quality insurance at that. Very robust coverage. And guess what? That creates adverse selection situations done by the individuals. As I mentioned earlier, this could be deliberately or non-deliberately. That's the way it is. But the fact is, it's done, and it's unintentionally. What's good for one party might not be good for the other party, so adverse selection could be coming into place. Risk selection occurs when insurers, though, have an incentive to avoid enrolling people who are in not so good health and likely to require costly medical care. Now, ACA insurers are no longer permitted to deny coverage or charge higher premiums on the basis of health status, but they still can go and try to attract the healthier clients through their plan design tools, restrictive drug formularies, large deductibles. But again, the gig is over to some degree, because if they're not picking up some statistically not so healthy claims, they may end up having to subsidize the groups that are filling that void. So the whole objective of the ACA risk adjustment program, and admittedly with the other type of programs, was to bring comfort and stability to the insurance carriers if they got saddled with bad risks. The risk adjustment program was basically, I called it the Robin Hood technique, redistributing funds from plans with lower risk enrollees to plans with higher risk enrollees. Little different was the temporary reinsurance program. Now, we see aspects of this coming back, but it basically provided payments to plans that enrolled higher cost individuals. There was a reinsurance program, and we had the temporary risk corridor program providing a program to limit losses and gains beyond an allowable range. Now, the concept was we needed in the beginning because of all the ambiguity of what ACA would be doing, but the reality is it's now a concept that may come back to pass. Now, when we talk about the healthcare reform, participants in the ACA risk-adjusted community and look at the ACA temporary reinsurance insurance program and the temporary ACA risk corridor program, we also want to look at what is the target audience in those programs. The participants in the ACA risk-adjusted program, they basically were the non-grandfather individual and small group market plans inside and outside of the public exchanges. The ACA reinsurance program participants, they were basically all of the non-grandfather plans health insurance could participate in that, whereas the ACA risk corridor program, the third one, the goal was to provide, in essence, an efficient way for qualified health plans, in essence, in the public exchanges. Now, I share a lot of enrichment related to this concept so people can grasp how the provisions of ACA were designed to impact health services, and including the marketplaces, the public marketplaces. The market, again, it's like a stock market. You can pick and choose. You have many options. That was the whole concept of calling it the market. It definitely is going to be less efficient if the carriers end up cherry picking the groups. And that is why, to review, these initiatives were developed with the whole objective to promoting insurance competition on the basis of quality and value to the consumer. What is adverse selections? When those who become unhealthy quickly find and enroll in comprehensive coverage. But at the same token, we want to encourage individuals to seek protection at all times, sick or not. ACA wants to have a large homogeneous group in the populations. That's why there was originally the concept, hey, we'll penalize you if you don't have it. And that went by the wayside of the actual penalty. But the really key issue is we're trying to cater to everybody to have health care. And yes, the healthies will be subsidizing the unhealthies. But to encourage individuals to seek protection, even if they don't feel they need it now, is an interesting situation. Some people feel like they walk on water and they're not susceptible to healthcare concerns. Although not addressed in the reading, I want to emphasize a few things. Adverse selection by the consumer, that is, if I can use the word, against the insurer or the self-funded plan or the self-insured plan, if you want to use that word, it occurs for those that are kind of facing with an upcoming major ailment. And definitely people seeing that coming are going to go for the most robust plan tailored to their own situation. And flipping the coin, carriers are using that same risk selection thing as we mentioned earlier. And the objective is to discourage any unhealthy participants from enrolling in their plan. They may say, but I got news for you. It might behoove them to even go to those populations and get some of the credits that are available to you at this time, is what I tell the insurance companies looking at this model. So be careful on understanding the different types of models. One's permanent, the other two are temporary. Aspects of it are still coming to life. Carriers may encourage healthy participation and enroll in their products through low premiums and high cost shares, but the gig is being looked at very seriously, as I can phrase it with that phrase, and the new programs are designed to minimize that impact. There are some great concepts on page 61 of the text. I encourage you to look at that. I call this concept as looking at some of the benefits in action, because it can help look at some of the options that are available to you as you design your own plans. And that's in addition to the discussion questions that I've posted on the board. Now, when we look at some of the other specific administration details of ACA efforts to control adverse selection, the whole focus is going to be on mitigating negative effects of adverse selection. And it was done to some degree, but we still may have aspects of what I called earlier the Robin Hood effect. How to control it. The premise of controlling negative effects of risk selection, it's there, but the risk adjustment plan is to compensate plans for their high-cost enrollees. The second set of readings that were in the assigned readings for the module kind of just phrases some of the things slightly differently than the first set of the readings. Similar material, just takes it from a different perspective. And it just talks about the methodology used by HHS under its risk adjustment program. Now, in all times, we're still protecting consumer privacy and confidentiality, but we're grasping some of the information to look at risk scores based on an individual's age, gender, and diagnosis. So that's how we get some predictability factors, which lead us to the risk score. Once the individual risk score is calculated for all the enrollees in the plan, then the values are averaged together across the plan to arrive at the plan's average risk score. Now, this whole objective is to mitigate incentives for plans to attract healthier individuals and also to compensate those that enroll in a, let's call it a not so healthy group. This whole temporary reinsurance program was also designed to compensate plans for their high-cost enrollees, because the rule of thumb was, okay, everyone, sign up for insurance. We want to make it available. And there was some concern that high-cost enrollees would pop in, so there was some accommodations that were made, so there was that temporary reinsurance program in place, as well as some risk corridors that were intended to reduce the uncertainty the insurers faced, especially in the early years of the implementation of ACA. Now, why do we mention these two plans that aren't around anymore? We'll get to it. But with the concern that people have with pandemics, perhaps some of these programs can be resurrected again. That's the click. So as we look at some of the risk mitigation mechanisms related to COVID in similar situations, now this comes to light. Insurers face typical risk mitigation mechanisms to consider due to unpredictable uncertainty, and COVID-19 is a good example of that. We had pricing risk where the premiums were maybe not enough to cover claims or too high, and there was an unintended windfall. Now, we have some mitigation mechanisms in place, like the risk corridors, and additional ones can be created if this becomes a major concern. Now, we didn't have to pull out the stops with COVID-19, but we could have it something similar revisited at some point. One opportunity may be to reevaluate the risk corridor concept. Now, there are two types of risk corridor concepts. One is the one-sided risk corridor, and the other, obviously, is the two-sided risk corridor. Risk corridor is we cover the losses, whereas the two-sided is we'll spot you for the losses, but if you get excess gains, you got to spot us too. A lot of this are spins on the medical loss ratio, the MLR, over a period of time. And there's a movement to let the medical loss ratio to give the insurance carriers some relief, is that it won't be a one-year snapshot at all times, but make it a 3-year snapshot. Now, the aggregate reinsurance potential for downside risk after the threshold is an interesting concept that's out there. Risk corridors may present supplemental payments for special occurrences. And now, why do we bring this up? Concept was there for 3 years. Well, that is to some degree what we now have with Medicaid. It does that to some degree. Moving on to this, some plan-specific potential, some actionable steps to response to adverse selection. Now, some of these concepts are are key because we are worried about the ambiguity of claims coming up if another pandemic occurs. There's variations of risk corridors that could be reintroduced. Sure, we had the formation of those in 2013 to 2016, part of the 3-year period. And yes, we talked about the one-sided risk corridor where the government paid the insurer if their losses would exceed a certain threshold, or the two-sided risk corridor, very similar to even Medicare Part D is done, with the threshold either way to make any payment due to come to the government. Now, don't confuse what I just described on the risk corridors with the medical loss ratio. It's a similar concept, but the difference is on the risk corridor, if it's two-sided, you're paying back the government. Or you're paying the government to some degree on the Medicare D. The medical loss ratio, if an entity is, it's more goes to administration costs and not to medical care, the medical loss ratio basically, then the surplus, if I can call it that, through threshold money, goes to the policy holder. In essence, it could be the employer. How the employer divvies it up to the employees, that's another story. But it goes back to who's paying the premium. Now, the aggregate reinsurance potential is out there. We're not doing it now, but perhaps from the government, the downside risk after the threshold concern could then be minimized. So we do have some concepts on the table if people are concerned about how to address a pandemic. It could be as simple as having supplemental payments for special occurrences, similar to what Medicaid does. It could be prospective or retrospective mid-year capitalization rate adjustments, similar to what Medicaid does in some states. The whole thing comes on looking at some of the issues like the pricing risk. A pricing risk arrives because it's not always possible to foresee circumstances and situations or even the availability of new treatment options that are on the table. So let's summarize. How can we mitigate pricing risk? The utilization of risk corridors, the medical loss ratio requirements, looking at that aspect, the aggregate reinsurance philosophy, perhaps from the government, to minimize the downside risk, or the prospective or even a retroactive mid-year capitalization rate adjustment. There are plan-specific adverse selection risk things, and this concept can be explained or brought in quite simply. I look at it as a budget-neutral risk adjustment program that is already out there. It already exists for small groups and individual markets. We see it at the state level, where the insurers are looking at concurrent data. Yes, concurrent data that's out there. We also have the Medicare Advantage Plan, Part D programs as well. That's not budget neutral. That's not playing the Robin Hood effect. Basically, we'll use some risk adjustment program, and the model here is it's prospective in nature. That could have some negatives there. See, the diagnostic coding during the prior year is used to develop the current plan year risk scores and corresponding premiums based on CMS. But we're not talking about the zero-sum game, the budget-neutral exercise as we did on budget-neutral plans. No, what we're saying here is the plan would receive higher payments, in essence, from the government, if they have higher risk scores, regardless of the risk scores from the other players. The Medicare Advantage bid process and CMS budget funds any of those expected payments. So again, two plan-specific ways to address adverse selection. One is the budget-neutral approach, the zero-sum game, and the Medicare Advantage approach. Now, we also have some risk of higher cost enrollees. In essence, individual reinsurance can address the risk, but we want to be mindful that the costs from health needs that arise unexpectedly are not typically part of this risk adjustment process. then we're not looking at high cost outliers, but we're looking to address costs that can be predicted. Now, don't forget some of the tools like individual reinsurance that is available. It's a model, specific reinsurance or stop loss. It can operate as a government-sponsored reinsurance program, be it a reinsurance dollar threshold-based program or reinsurance condition-based program. The private insurance program is also used by employers and other groups and can create a great template. But with any aggregate reinsurance, private reinsurance, included, it can really be done in many aspects, including specific reinsurance or stop-loss coverage. So we've covered a lot of the implications of risk mitigation mechanisms for COVID-19 or similar related risks. The issue is, as we looked at some of the risks, we did not have the negative impact as many people thought. Elective surgeries were delayed. We didn't have that shocker. But we want to be very sensitive to some of the opportunities that are before us. Yes, there are concerns with the viability of risk corridors and other efforts to stabilize benefit plan pricing, and there are many proposals that are out there on the table, including to subsidize COBRA premiums, not currently that are out there. But there is a concern also that if a recession occurs, that may bring increased morbidity. That'll also get some claims will come up. People gravitate to do elective surgeries. Hey, if they're out of work, let's do it. And it could be at that same time, especially if there are issues with the recession, the employer might not be able to fully fund the plans in the robust nature they did. And some of the states might not be able to do Medicaid as well. So that takes us to some of the practical things and other considerations that are out there to risk adjustment mechanisms to look at. I hope this review has been helpful.